Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brian Madden, Chief Investment Officer at First Avenue Investment Counsel, will be joining us for the hour. In 30 minutes, we'll get the latest read on U.S. inflation. We'll digest the numbers with Ian White, Chief Economist at Huntington Commercial Bank. And we want to hear from you this morning on First Call. Reach out with your questions on North American large caps, and we'll have Brian answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about a half an hour, and our email address, if you want to go that way, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Bank of Montreal is selling its business that finances trucks, trailers, and equipment to New York-based asset manager Stonepeak. The unit has more than $14 billion worth of loans on the books. The bank expects to use a portion of the payments to take a stake of nearly 20% in the new entity. Terms of the deal were not disclosed, but BMO expects to record an after-tax charge of about $900 million. Shares of Hims and Hers Health are down in the pre-market. The telehealth company reported a loss and missed sales and revenue expectations for the first quarter. This comes as the American company faces higher costs associated with its pivot to branded weight loss medications. On the other hand, following its partnership with Novo Nordisk and Eli Lilly in the last 2 months, Hims is now raising its full-year revenue outlook. Shares of Organigram are down sharply in the pre-market as second quarter revenue for the cannabis company missed estimates. The Toronto-based company says underperformance in vapes and temporary challenges in infused pre-roll production, along with slower industry growth, distributed to the quarter. On the upside, Organigram is raising its guidance for the full year after acquiring a German cannabis company last month. And now our top line story. The markets are edging lower as technology stocks retreat from record highs, giving investors pause ahead of key U.S. inflation data that could shape interest rate expectations. Now, at the same time, oil prices are climbing for a third day as tensions in the Middle East intensify in hopes for a stable ceasefire fade. Let's bring in our guest for the hour, Brian Madden, Chief Investment Officer at First Avenue Investment. Brian, always good to see you here. Thank you for joining us as always.
A real pleasure. Thank you.
And we're going to talk oil. I think we didn't talk about it last time you were here. No, we talked about oil last time. We talked about the Middle East the last time. Is this time different?
It's a popular topic, Roger,
yeah.
And it's one that is lingering longer than what was originally planned. There's fits and starts. We do think that both sides sort of want to de-escalate this situation. No one is winning, or by definition is a failure on both sides, a failure of diplomacy. And so Iran is starved for cash. The country has been decimated, and the United States has got a lot of political problems that have been brought about by this, given what's happened, prices at the pump and everything else downstream of it. So, I think we're probably closer to the later innings than the earlier ones, but, the belligerence is really not helping.
And now the markets are pulling back. Is that just a little taking some profits right now, do you think?
Yeah, the markets, let's face it, the markets have been screaming hot. Case in point, you look at the month of April, the S&P 500 was up 10.5%. So that is the fourth largest single monthly return in 30 years. So we're in rarefied air. This is a 1% sort of an observation.
Yeah.
It's the second strongest monthly return if you take out the wild yo-yo action of the COVID era in 2020. So, we're not that surprised that markets might take a bit of a breather, blow off some steam. You've sort of got the most of the majority, the first quarter corporate earnings results behind you, which, to be fair, have provided real substantive support for share prices. They've been sensational, in a word.
All right, and so that focus there, what kind of a factor then is inflation today? One of the numbers we're going to be talking to Ian Wyatt from Huntington Commercial Bank about it, and they're predicting 3.6% in the U.S. for inflation year over year.
Yeah, this is well telegraphed, of course, because we know that oil, has got a big weight in the CPI basket. But of course, Roger, it's actually much bigger than that, because oil and energy is implicit in all manufactured goods, because unlike services which don't need to be shipped, manufactured goods do. So freight is part of the landed cost or the retail price of everything. So it's a big issue. We'll see whether it ripples through to the same extent into core inflation. Probably not. We were somewhat encouraged to see the jobs report came in better than expected last Friday. Wage inflation wasn't picking up, or not meaningfully so. So you're not seeing the dreaded wage price spiral that characterized the stagflation of the 1970s. But make no mistake, we're in a market environment, an economic environment that's stagflation-like.
It's sitting there. What number, if it comes in around what everybody's expecting, is the market already factoring that in? Or is it still going to be a shock? Or if a bigger number, what happens then, do you think?
Well, a bigger number probably prompts more of a sell-off than what's already implicit in the futures prices. But if it prints sort of right on the screws where the consensus is, as I said, we think it's been pretty well telegraphed. You'd have to have been living under a rock to not see what's happening with oil and gas prices, and further that's going to ripple into broader consumer price inflation.
And we're even hearing, I've seen some notes that Trump is considering dropping some of the federal gas taxes to try and bring the same. I mean, it's an election year, and it's coming up fast.
Yeah, I mean, this is a fairly simple fellow, so I think as much as some would infer that we're playing 3D chess here, I think it's actually much simpler than that. You can boil down what he probably sees as a scorecard as the price of the S&P 500 and the price of a gallon of gas. So can you get a quick win, so to speak, by lowering or suspending the federal gas tax? Yeah. So we've seen this here in Canada. So it's not a bad idea, actually. Yeah. You brought about this problem, and you have some tools in your toolbox to fix it. That would be one of them. The Strategic Petroleum Reserve releases that we've already heard the United States and other countries doing is another means. But let's make no mistake, your hands are somewhat tied. 20% of seaborne oil does flow through that choke point, and it's not moving.
But it does, it feels to a degree like somehow people have adjusted. I know Europe or Asia is feeling pressure, and there is concern in Europe, but they've managed to redirect a lot of the oil, it feels like, going north or to the Red Sea and not through the Strait.
Well, there's limited capacity to do that. There's a pipeline that'll move, I think, 2 million barrels a day across the Emirates over to the Red Sea, and it can be moved on tankers from there. But, I think the real issue is it just hasn't moved all the way through the supply chain, and it's starting to right now. You see financial markets tick and, flicker in real time, and they're knee-jerky. And so as soon as the first shot is fired, oil's up $20. But the real physical shortage of diesel and jet fuel and distillates and gasoline, takes time because there's stuff on the water and seaborne and stuff in storage. But the longer and longer this drags on, the more you have the dreaded 1970s scenario where you've got 3-hour-long lineups for gasoline at the pumps. Now, that's not going to happen in all likelihood in the United States because they're largely self-sufficient in oil. Europe, Asia,
not so much.
Not so much.
Yeah. And they face the challenges, but the oil, whether there's shortage or not for the U.S., though, it's the prices that are going to drive everything for them right now.
Yeah, this is going to change behavior, and so far the consumer has been fairly resilient. We're not seeing it yet, but again, the longer this drags on, the more you sort of sap that resilience and the liquidity and savings that people have, particularly in the lower slant of the K and the so-called K-shaped economy.
And we're still very much in that right now, aren't we, a K-shape?
Very much so, yeah, very much so. The upper slant is, it's party like it's 1999, the S&P 500.
Wait a minute, maybe not 1999.
Yeah, maybe invoking the ghosts of bubbles past. But no, it's good times for people who have assets, particularly stocks, and not so good if you're paycheck to paycheck and are really feeling acutely what's happening in the grocery stores and at the pumps.
All right, we'll leave it on that note there. Up next, new federal and provincial initiatives are aiming to make it easier for large investment projects to move ahead in Canada. Get Brian's thoughts on those. That's up next. Let's see how things are shaping up on the markets. We'll start with U.S. futures. And as we were talking about, a bit of a pullback. They're not much more. The NASDAQ off by close to a point. The Dow, it's down by about 0.12. Over in Asia, an interesting day. Nikkei up by a half point, Hang Seng by 0.22, and the CSI down by 0.22. The CSI 300 also off. And South Korea, the Kospi was down as much as 5% on some reports that maybe South Korean citizens should share in AI profits, and that drove down SK Hynix and Samsung. And the policymaker who mentioned that has since backtracked on that one. Heading over to Europe. And pretty much all red as you look at the European markets. Now the FTSE off by a half point. There's a lot of concern there politically. And we may see a change of government yet again. CAC off by 0.6. Some concerns about the Middle East. Same with the DAX off by more than a point. And the TSX yesterday managed to finish the day on the plus side, up by 0.18%, but only 3 indices were actually in the green. Tech was off by nearly 5%, healthcare by more than 2%. Some of the winners and losers yesterday. Endeavor Silver, that's what was driving it, up 12.6. Silvercorp up by 9.1. Going the other way, Shopify taking another hit, down nearly 7. Bausch & Lomb, the same. Looking at the metals now, and gold pulling back a little, off by 0.34%. Same with silver. It's been pushing up in the last couple of weeks, but off today by 1.9% at 84.34. And copper surging again. Look at that, it's almost up at 6.50, it's up a quarter point. And taking a look at Western Canadian Select from yesterday, it was up. Not surprising on all the pressure from the Middle East. And it was up 3.76%. And today, WTI, not surprising, back up over 101 actually. It's up 3.4% right now. All right, governments are introducing new investment funds, policy offices, and partnerships to support projects in areas like energy, housing, infrastructure, and transportation. For investors, the focus is on reducing financial and regulatory barriers and encouraging more private capital and skilled workers to invest and remain in Canada over time. We're back now with Brian Madden from First Avenue Investment Council and get his take on Canadian policy developments, the good, the bad, maybe the ugly to you.
Well, let's start with the good.
All right, let's do that.
We talk,
it's always nice to have some good.
Isn't it, though? We talk a lot about war and inflation, and nobody likes that. But as the old adage goes, the markets climb a wall of worry. And so why do they do that? Because beneath the top line, the headlines, there's good things going on. And so we are really increasingly encouraged by some of the policy developments we're seeing in Ontario and Canada more broadly. So just to name a few of them, to great fanfare, we saw, I believe it was last week, the Carney government in their spring economic update, what we used to call the budget, unveiled this Canada Strong Sovereign Wealth Fund. It's going to be capitalized over time with $25 billion and a mandate to invest in projects of national importance. Add to that what we've seen already that's been stood up a few years ago as a special purpose entity under the Public Sector Plan Investment Board, the Canada Growth Fund, and here in Ontario, the Building Ontario Fund. Both of these are special purpose entities recently set up and capitalized, $15 billion in the case of the Canada Growth Fund, $8 billion in the case of the Building Ontario Fund. And their mandate is to act as catalytic investors, in effect providing concessionary, so below market rates, and strategic financing in order to essentially push projects over the viability tipping point, such that the private sector can then provide the remainder of the funding and bring some of these projects to fruition, get them off the drawing board.
Now, do you have confidence that government can do that, though?
Well, policy effects don't take place immediately. We believe the will is there. We also acknowledge it won't be easy, but we take a lot of comfort in seeing that it's not just money. So you can throw money at problems and they don't go away. But in tandem, what was set up last fall, again, a federal initiative, the Major Projects Office, with a view to being an ally for private sector projects so that we can debottleneck them, got through the red tape, the muck and the mire, and all the things, the own goals and roadblocks we put up in our own way, that to the detriment of growth and productivity and overall standards of living. I mean, it's been noted widely that there was $1 trillion exodus of foreign investment from Canada from 2015 to 24. was noted by the Bank of Canada, the brain drain problem brought back into focus that...
Yeah, people are graduating and they're gone.
Yeah, that's right.
Because the jobs are south or Europe or wherever.
So of the Canadians that are living and working abroad, what this Bank of Canada study cast light on was that 40% of them, had they not emigrated, had they just stayed in Canada, would rank in the top 1% of income earners in this country. So there's a five-alarm fire. There's an exodus of capital. There's an exodus of talent. But policy is moving in the right direction, so we don't waste a single minute of our time lamenting or scapegoating why this happened. And why? Because markets, stocks, bonds, currency, they're forward-looking, not rearview mirror looking. So what we see, you brought up earlier on one of the previous boards, the Nikkei 225. I took note of that, 62,000 and something. Yeah. Quietly, Japan started enacting policy changes, liberalizing social policies, liberalizing immigration, changing corporate governance rules, and very quietly, and few know this because the S&P 500 sucks all the air out of the room, but the Nikkei 225 is the best performing stock market, large one in the world over the last 5 years. So we're sowing the seeds with policy developments and investments that will allow Canadian investors to reap and harvest the benefits over the coming decade, just like Japan has.
All right, that's the good. What's the bad? What's missing, or what would you like to see?
Well, we'd like to see them move quicker, frankly. Yeah. So the intent is there. Direction and rate of change is correct, but more speed would be better. We'd like to see that.
But it's government. I don't know. Can government move at speed?
Well, I mean, they talk a big game. We heard this in some of the throne speeches and stuff. So we're going to see there is a very credible group of people that the Prime Minister has brought into his inner circle, people with real private sector experience, not just people who've shuffled files around on government desks for 30 years. So, if not now, then when? So we think there is a better than average chance that a lot of these things are going to actually take hold, come to fruition to the benefit of the economy and investors.
Any concerns about interprovincial barriers that they may go back up, and many of them haven't come back down, and those could be detrimental to any of these plans?
Yes, absolutely. And so this is actually a little bit more difficult to wrap your arms around and tackle than things that you can do unilaterally, federally, or in a single province, because it requires a whole of Canada, a whole of government form of collaboration, and all the bun fighting that occurs between the feds and the provinces needs to be put aside for the greater good. So that's easier said than done. We are in a possible sea change moment, though, aren't we, with this country? Yeah, I think so. I mean, certainly the only plausible direction of policy travel from where we were the last decade is an improvement, and we're starting to see signs that that intention is there with some well thought out ideas. We just need to see traction and action, and we think we will. All right, we're going to have to leave it on that note there. Up next, we'll be back with Brian to see why McKesson is on his radar. Time to see what's on the radar for Brian Madden, Chief Investment Officer at First Avenue Investment Council. First up is McKesson. What are we liking? What is it, first of all? I didn't have a chance to get a look at it. Yeah, and that's a great question. So it's not a household name, and yet it is one of the largest companies in the Fortune 500. Believe it or not, in the coming year, they're likely to have $440 billion of revenue. Wow. Now, the margins are very thin. So what is it? It's the largest pharmaceutical distributor in the United States. This is an industry that's basically an oligopoly where McKesson and its two rivals, Cencora and Cardinal, have a collective 90% market share. Needless to say, it's an industry that serves a need, not a want, moving drugs and molecules branded and generic from the manufacturers to pharmacies, hospitals, long-term care homes, and other primary care endpoints. Beyond that, it's got a technology solutions business and a smaller medical surgical business and an oncology and multi-specialty practice, but 85 or 90% of the business is pharma distribution. It's very sticky business, so no major national account has switched from one to the other of the three. I was going to say, is there competition, or are they kind of essentially all quite happy where they're at? Well, once in a while, some insurer will switch from one to the other, but major national retail accounts have been very sticky. The switching costs are high, and it is very competitive. The margins are super skinny. It's about 1% operating profit margins. So this is a company where the share price has corrected more than 20% off the highs in March. Its major rivals, Cencora, reported a pretty sloppy quarter last week. There were concerns that the problems plaguing them might be endemic to the industry. McKesson reported a couple of days later. I think their earnings report alleviated those concerns. This is a company with very high returns on invested capital. It has paid a dividend for 25 years. It's increased it at a compound pace of 14% over the last 5. Catalyst on the horizon. They're spinning off the medical surgical unit, which we expect will unlock some value. So we think it's a pretty timely entry point and a pretty defensible all-weather type of company, frankly.
All right. Stock number 2, Alamos Gold. You still think there's room for gold?
We absolutely do. So this is a company we've owned for some time, over a year, I want to say. It's also corrected along with the gold price in general. It used to be a mid-cap company. It's much bigger now, as all the gold stocks are, with the phenomenal run in the commodity. Nevertheless, undemanding valuation. It's about a $25 billion market capitalization company. They're producing today about 500,000 ounces of gold across 2 mining districts and 3 mines in Canada and 1 in Mexico. And they've got a pretty good line of sight at their own properties without any greenfield exploration requirements or expensive acquisitions to get to about 1 million ounces in the next 5 or 6 years. And so we like sort of the asset profile, very low political risk jurisdictions, good management team under the leadership of the founder and the CEO who's been there since I think about the turn of the century. And as I said, we like the pullback, and make no mistake, we are still bullish on gold as sort of an anti-fiat currency of sorts in this time where people are questioning the safe haven status of U.S. dollar and treasuries. And
the dollar's on a bit of a slump again right now, isn't it?
That's right.
And so where do you see gold going then?
We see it resuming its uptrend. So, it kind of went in a strong bull market, the best one we've seen since I think it's 1981 or thereabouts, 1979 last year. I forget what the percentage return was, but then a lot of chasing occurred in January. That steep sort of spike in the chart that we see on the screen there is psychology getting the better of investors. And so that's what you'd call a blow off top if you're a technical analyst. When you have a period of time like that, sometimes you see a bit of consolidation, a bit of pullback and base building, and we think that's all that's really happening. So where is gold going? I'll never be the one so foolish to give you a price target with a date and a price.
$72,000.
Because I'll be wrong 100% of the time. But the conviction that the path of travel is upward remains very, very strong. And to be clear, we've been long and strong in both of our equity mandates in gold, miners, and royalty companies since 2022 when Russia invaded Ukraine, which is what touched off, really, this latest leg of the bull market rally, all the central bank buying and what have you.
Are you surprised what we saw with gold, though, since the Iran war and how it hasn't reacted as much as I think a lot of people thought it might?
Yes, candidly, but I think humility is the real currency in this business. And gold, I got a Library of Congress of facts and figures about gold in my head accumulated over 30 years. But the more facts and figures I have, the more I have to just concede gold is really an enigma. It does what it does. The chart will tell you what it's doing. So, if I try and weave together a narrative, why is it doing what it's doing? Because the trade got crowded. That's why it was spiky in price in January. A lot of leverage and margin and speculators crowding into it. And then we had a very risk-off market when the war in Iran started. And so what happens when you have to degross and deleverage? You sell everything. In particular, your winners. Gold stocks have been standout winners, and they were ripe for that sort of deleveraging and de-risking trade.
All right, we'll wrap it up on that note. There's still ahead. New data on the U.S. CPI for April is out this morning, very, very shortly. We'll break that data with our next guest, Ian White, Chief Economist at Huntington Commercial Bank. Also, our phone lines are open soon for our first call segment. Reach out 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. All right, we are just getting the latest inflation numbers from south of the border. Quick look here. CPI month over month, 0.6%, same as the survey. Core CPI month over month, 0.4%. Survey was 0.3%. And here's the big one, year over year, 3.8%. The survey was 3.7%. And core CPI, 2.8% year over year. And 2.7% was what we were expecting. For a little more reaction and in-depth analysis, we turn to Ian White, Chief Economist at Huntington Commercial Bank. Ian, thanks very much for joining us this morning.
Thank you for having me. I appreciate it.
Okay, 3.8. You guys were expecting 3.6. What do we know? What's driving this? The even bigger number?
One of the things we've been watching for a while is services. Last year, a lot of the conversation was about tariffs in terms of inflation, but in the reality, when you looked at what drove inflation last year, it was lower end labor costs. So we had, that was up 0.6% month on month. We also had a decent jump in food as well, 0.5. That's going to be kind of an obvious pass through though, from energy costs and oil costs directly to food. It's pretty heavy diesel using industry. So some of that was expected, but yeah, a little hotter than we were estimating. There was some weird effects though in terms of shelter as well that's worth mentioning.
What were some of those?
Sure. So in shelter, what happened basically was because the government shut down back in October, there was some statistical anomalies and BLS had to basically change the way it calculated shelter for the next few months. They will. And so what they did was they basically had 2 months of shelter inflation packed into 1 month here. So it should be going forward. That should be corrected. And actually, shelter was something we were pretty positive about, lower shelter, much like north of the border, south of the border as well. We have fairly weak shelter inflation happening, especially if you look at the market rent indices, which tend to move before BLS's indice. CoStar's at basically 0.0% year-on-year inflation.
Ian, just thinking about sort of forecasting inflation, obviously economists have lots of time and elaborate models to throw the 1,000 prices in the blender and build their forecasts bottom up. But if you're a do-it-yourself investor or looking for a shortcut, are there things that you can point to? And for context, we had a summer intern we brought in last year, and we wound him up on a project to look at market implied inflation as measured by the TIPS, Treasury Inflation Protected Securities Market, and also the University of Michigan 5-year inflation forecasts from that survey. And his work found that actually both of those have some predictive power, but at different times. So any thoughts on what those surveys or signals are telling you? Because they're pretty divergent, with the University of Michigan reading much higher and the bond market much lower.
Yeah, I always think gasoline's such a thing on the front of people's minds. And yet, in terms of the overall spending basket for the US, for almost every quintile of households up until the top quintile, it's roughly 4% of spending last year. We see it going up to 5 to 6% this year. So people talk a lot about gasoline, and I think that really drives, when you ask them a survey, what am I thinking about inflation? The reality is something that's much bigger is, overall services inflation, wage costs there, healthcare inflation, that really drives into PCE, much less in CPI. That's actually one of the big differences between the feds, because all that indirect healthcare spending that we get from our insurance companies doesn't count in CPI. And the other thing in CPI, of course, is shelter. And for a while, we've had really robust shelter inflation. That's come down a lot. That's helped a lot. And for a lot of rental households, you're talking a third of their income, whereas, we're focused on gas prices, which are 4 or 5% of their income.
And that's making the difference. Now, so would this make any difference? We've heard Trump musing about maybe dropping the federal tax, one of the federal taxes on gas. Would that help at all then, really, or is it a drop in the bucket, so to speak?
It wouldn't hurt. Certainly, we've seen stimulus effects this past few months that probably have helped offset some of the pain at the pump for consumers, because there were a couple weird things from the tax bill last year where a lot of the effects didn't actually hit till this year because withholdings didn't change. And so therefore, people got a little bit bigger paychecks start in January, and they got bigger refunds because they had higher withholdings last year. You put that together, it's typical household, you're talking 1 to 2% of their income, very actually similar to the hit from gas prices. So that stimulus effect has helped. So we've definitely had some stimulus that's helped offset the effects of higher gasoline prices on households. And that's part of why, when we look at the consumer data, if, you can, on your terminal, you can look at Bloomberg second measure. We have some other real-time spending metrics we can look at using credit card data that's not public. And when you put that all together, you see a consumer that's still spending at a fairly similar clip for non-gasoline products, including sensitive areas like restaurants, airlines, that tend to be sensitive when consumers pull back. So we're still seeing a consumer spending. We still see a fairly resilient consumer. it probably wouldn't hurt lowering the gas tax in terms of that stimulus. But at the same time, on the rate side, that also can push up rates.
Ian, how do you read the interplay between labor markets and inflation? And just thinking about this word transitory that, has probably been the Achilles heel of the Federal Reserve after experimenting with it post-COVID. But then we had very tight labor markets and then we got the supply shock of the Russia-Ukraine war and the oil price spike. And so you got the wage price spiral. Labor markets seem to be somewhat looser now. So how are you thinking about this oil shock and how it feeds through into the dreaded wage price spiral in today's environment?
Yeah, that was a good point. I love that point Powell made. You kind of made the same point here that, we have all these transitory shocks, and we've had essentially 4 distinct shocks when you count, COVID, the Russia war, tariffs, all these things have been inflationary shocks. And now we have another one in the last 6 years or so. And at some point, is a transitory shock a normal reality we're living with? Maybe. It's certainly become more common, and I think the bond market has priced that in a bit. On the labor force side, I'd say we kind of see a two-speed labor market. If I talk to companies that are competing for hourly workers, lower end wages, they still see a fairly tight market. It's not as crazy as it was a couple of years ago, but they still see a fairly tight market at the lower end of the labor market. If you're fast food, warehouse workers, that kind of thing. I mean, part of it is you have, say, the big warehouse companies, and Amazon is paying, I think, an average of $23 an hour. And that's a very large employer in a lot of areas. It's really pushing up hourly wages. We're seeing a tight market. But if you talk to, parents or new college parents of or new college grads themselves, they'll say it's a tough market for the college grads, new college grads. And it kind of fits which industries are hiring. The industries that tend to hire a lot of college grads are the ones that aren't hiring in significant ways. More lower end, including actually healthcare, is a shockingly low end industry. The percent of jobs that really are, cleaning bedpans, providing food services is a pretty large percent of the healthcare market. And so you see that's a big part of actually where the job growth has been in things like home health aides. So that market we still see as relatively tight. Not the same turnover as it was. And that's creating challenges. And I think that's part of why we're seeing, you look at food away from home, still up 3.2% year on year. You have services up 3.4% year on year. These really reflect partly, wage pressures in that space.
All right, we have to wrap it up there, Ian, but thanks as always for joining us. Appreciate it.
Thank you for having me. Really appreciate it, Roger and Brian.
Ian Wyatt, Chief Economist at Huntington Commercial Bank. Let's get to some other stories now that we are following in the BNN Bloomberg newsroom. The Bank of Montreal is selling its business that finances trucks, trailers, and equipment to New York-based asset manager Stonepeak. The unit has more than $14 billion worth of loans on its books. The bank expects to use a portion of the payments to take a stake of nearly 20% in the new entity. Terms of the deal were not disclosed, but BMO expects to record an after-tax charge of about $900 million. Pet Value's first quarter revenue met analysts' expectations, but same-store sales remained flat. The Markham, Ontario-based retailer also cut its earnings forecast, citing persistent consumer weakness and higher costs in the early part of the year. Pet Value says Q1 performance was affected by a rise in value-seeking consumers who leaned into discounts and promotions. Shares of GameStop are down in the pre-market. eBay has rejected the $56 billion proposal to take over. That was the offer that came from the video game retailer. eBay is calling the unsolicited bid neither credible nor attractive. Last week, GameStop offered a cash and stock deal to eBay with a 20% premium. In its takeover bid, GameStop suggested its U.S. stores could be used to authenticate collectibles and as shipping centers for the e-commerce website. Still ahead, can great management actually be measured? And how do you tell real skill from lucky timing in a bull market? We'll get answers on that after the break. And, of course, our phone lines are open. Brian Madden is taking your questions on North American large cap stocks. You can reach us at 1-855-326-6266. And, of course, email us as well. First call at bellmedia.ca. We are digging into what truly defines management quality in public companies, from capital allocation and credibility to incentives, governance, and board strength. For more on this, we're back with Brian Madden from First Avenue Investment Counsel. Brian, what do you like in a leader?
Yeah, I mean, so this is the art of investing. Yeah. The science is sometimes a lot easier. We learn it in MBA school or doing our CFA or CPA designations. So we can objectively say a PE ratio is high or low, a dividend yield is high or low, or return on equity is high or low. But the elusive qualities of management and leadership vision are sometimes more difficult to evaluate. So number one, we think capital allocation abilities are really important. So if you have a company that is very free cash flow generative, it's not inconceivable that during the tenure of an average CEO, 5, 6, 7, 8 years, the amount of free cash flow generated that needs to be allocated, either paid out in dividends or share buybacks or reinvested, could equate to the entire size of the balance sheet. So CEOs absolutely must be good capital allocators. Communication style. We want to invest in companies where the leadership is candid, humble, transparent, and credible.
That's a tough balance, though.
Well, it is, and that's why they pay them the big bucks.
Because some of those things get perceived as weaknesses, and
that's right. I mean, it's you need to have industry experience. You need to have fortitude, and in particular, so to the point of a weakness, you also need to have the courage to act and make difficult decisions when things are uncomfortable, because in any business they will be, from time to time. We also look at incentives and governance. I think it was Charlie Munger that said, "Show me the incentive, I'll show you the outcome." So we read management proxy circulars and we see how executives get their bonuses and what metrics are prioritized. So we like to see metrics prioritized that align with shareholder value creation as opposed to just empire building. So to give you a really good example, a terrible metric would be sales growth. A less bad one would be earnings growth. A better one would be free cash flow growth or improving return on equity or returns on invested capital.
So why is one bad, sales growth bad, and free cash flow growth is good?
Well, so imagine I've got a small but profitable company that's earning 30 or 40% return on equity, but the CEO's sort of bonus pays out if he doubles the size of the business. So how do you do that? You go and buy a company with a large base of sales that's unprofitable. Okay, done. Check the box and you collect your bonus, but you don't create any value for shareholders. So free cash flow growth says, okay, we're getting bigger, but we're getting bigger on the metrics that matter and drive value for shareholders. So it's to avoid the empire building impulse that can sometimes creep into executives' decision making. Mm-hmm. Secondly, sort of related to that on governance, it's very important for us to see a strong and independent board where there's really a culture of challenging management and holding them to account. The worst thing you don't want to see is the CEO sort of recruits all of his golfing buddies and says, "Come sit on the board. It'll be fun. We'll do a retreat in Florida in February." You don't want that. And then the other thing is, how do we develop well-informed views on management quality? Well, let's just face the facts. Like a company, a big public company, is a well-oiled machine. They have well-trained and skilled investor relations people, and the CEO's probably taken PR and media training. So they're going to be slick and polished and hair groomed.
Not always. Air Canada comes to mind right now.
Yeah, not always.
Not always.
So the best way is to attend, if you can, investor days in person, and that way you can sort of be involved in some of these in the break and at the lunch and in the hallway conversations and sort of get the real story and not just the on-stage spin. Another good way is to cultivate relationships with sell-side analysts who often spend long periods of time traveling around from meeting to meeting with corporate executives during road shows, so they get to know the real individual and not sort of the stage presence. So different ways, but it is quite important, and it's, as I said, more art than science.
Yeah. That for sure it is. Okay, we got to wrap it up on that note there. But still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a bullish stance on LVMH. The Let's take a look at some of the notable analyst calls and recommendations. Wells Fargo analysts started coverage of Capital Power with an equal weight rating and a $70 price target. The analyst is still positive on independent power producers, but believes investors need to be more selective. Wells Fargo notes Capital Power looks more expensive than Vistra and Talon Energy, and its Alberta assets offer less near-term upside from data centers. And Wells Fargo initiating coverage of Algonquin Power with an equal weight rating and a US $7 price target. The firm says the stock looks cheap and management is strong but wants to see more progress. It adds that ongoing regulatory changes are a key factor and could take time to deliver results. Barclays sees a buying opportunity in LVMH after the stock had its worst start to a year on record. The firm says concerns about slower luxury growth and weaker consumer demand have weighed on the shares because LVMH is seen as a barometer for the sector. Barclays upgraded the stock to overweight from equal weight, citing underestimated improvements at key brands Tiffany and Dior. And when we come back, Brian Madden takes your questions on North American large caps on First Call. Now for First Call, and that honor belongs to Tom from South Bruce Peninsula, beautiful little spot in Ontario. Tom?
Yeah, I was just wondering if Brian would take a look at the Exchange Income Corp, that this would be a good time to put some money to work in that stock. It looks like they've had a decent quarterly result here. So, just wanted Brian's thoughts on that. Thank you.
Thank you for the question, Tom. So this is sort of an odd-named company, and just for the benefit of viewers who may not be familiar with it, it's a conglomerate of sorts, or I sometimes describe it as a private equity fund specialized and focused in industrial and transportation businesses. We don't own it. We have been getting more and more interested in it, particularly with some of the policy developments that we're seeing federally over the last year, notably a lot of money flowing to northern Canada. So what this company is comprised of is a couple of transportation businesses, in particular regional airlines that serve remote northern flying communities. So the thinking is if we get Arctic bases and more money flowing to some of these northern communities, roads and so on.
Get them there.
Yeah, that's right. So these are businesses that sort of have the know-how to operate in difficult, hostile, and I mean climate hostile environments. So could there be some maintenance repair operations business that these transportation airline businesses pick up? Perhaps. The other side of the business is a collection of industrial products businesses, so building supplies and things like that. And so unlike a lot of private equity funds where it's sort of acquire, slash, burn, lever up, flip, and spin, this is a firm that sort of buys businesses and keeps them for a very, very long period of time. So we generally like the management philosophy and have been dusting off the file on it, but don't own it ourselves at this point. But it looks interesting, we'll concede. And
the diversity is good to you?
Yeah, we like it. I mean, regional diversification, not great, but by line of business, yeah, it's pretty good.
All right, let's get to an email now. This one's from Jim. Do you recommend swing trading in registered and non-registered accounts? Do wealth management managers generally structure accounts using momentum trading? What weight should a sound portfolio be at risk?
Wow, there's a lot of questions in there. So
give you another half hour.
Let's knock them off one by one. We don't generally recommend swing trading in registered or non-registered accounts. And so why not? Because investing is hard. Let's just...
That's why I don't do it.
Yeah, let's just call a spade a spade. What we know is over the long term, stock prices follow earnings. So, that's almost axiomatic. What we also know is that the sort of swings and variations around those earnings can be wild, and those reflect changes in valuation and changes in sentiment. So it's difficult enough to predict earnings. It's almost impossible to predict the erratic changes and swings in sentiment. If you can do it, more power to you, but we think that there is a risk in doing it. If you imagine sort of different periods of time and imagine them like tide, wave, and ripple. What you want to do is align yourself with the tide and at the most maybe trade around the waves but ignore the ripples. So that's what we do. The second part of the question, do wealth management firms practice a momentum investing style? We do, not to the exclusion of everything else. We have a momentum equity mandate that invests in Canadian and U.S. stocks. That's led by my colleague Ian Chong. We also have a dividend growers mandate, and so one is more aggressive, one is more conservative, but momentum is a factor that works in stock picking. And the third part of the question, you might need to remind me.
What should a sound portfolio be at risk?
So I'm not sure exactly how this question is being framed, but you got to think high level. How do you diversify a portfolio by geography and by asset class? So we do that by investing in Canada, the U.S., in cash, in fixed income, in private equity, in real estate, and in alternative income. Within an equity portfolio, we tend to own about 30 stocks, so roughly about 3% weights per name, with a bit of variation around that.
Okay, we got to wrap it up there. But Brian, thanks as always for joining us. Always a pleasure, sir.
My pleasure.
And that is it for us here on The Street. Thanks again to Brian Madden, Chief Investment Officer at First Avenue Investment Counsel, for joining us today. Lindsay's up next with The Open. Trading gets underway about 30 minutes from now. Have yourself a great day.